Have you got a tax-free savings account? There are a couple of niggles and a couple of worries about the way in which the tax-free savings accounts are treated by people who use them and, of course, the people who provide those tax-free savings accounts as well. National Treasury has proposed amended wording to some of the regulations governing the tax-free savings accounts and at the same time emphasising that performance fees will not be allowed on those accounts. This is the MoneyMakers. I'm Bruce Whitfield. I'm joined by Christopher Axelson, who's Director for Personal Income Taxes and Savings at the National Treasury, to talk about the amendments to the TFSAs and why Treasury has postponed the transfer of existing savings in a TFSA from one product provider to another to March the 1st, 2017. Firstly, performance fees. I mean, this is such a contentious issue in South Africa where most of us have absolutely no idea what our fund's benchmark is. We have no idea what outperformance means, and it's a really good revenue generator for many of the product providers. Why don't you want them included in the tax-free savings accounts?
Well, I think when we started putting these together, we looked at them quite differently to how we regulate other products and what we do in the space, just because we're providing a tax incentive. So it's a revenue foregone for us, really. So we wanted to be just very comfortable in terms of the products that are invested in here. And as you say, they're not simple. And one of the things we really wanted here was for products to be as simple as possible, as transparent as possible, so you know what's going on, and just to be suitable for the average investor. So we were slightly concerned just about the complexity and the huge array of different types of performance fees that were out there. So, you know, we didn't allow them for tax-free savings to start, but that doesn't mean that we're not discussing this with industry. A lot has been said in the draft default regulations for retirement funds, and we put those regulations out where we said no performance fees, but we're discussing them at length with industry, and you know, we'll keep those discussions going forward to see what issues we have and why we're uncomfortable and if we can sort them out.
I mean, do performance fees generate a form of behaviour in the fund manager that shouldn't be in the TFSA space? Is that the concern?
Well, I think it's more about the transparency. You know, if it takes someone with a degree half a day to figure out what's going on. It's probably not simple enough just for these simple types of products. And it's very different, these types of products in a retail space, straight to consumers, compared to institutional investors who can have experts looking at these fees, trying to get a good deal, trying to align incentives, say, between managers and what they're looking for. So it's just a very different arena, and we'd be much more comfortable just in this retail space to start to disallow them for the moment.
For the moment, I'm glad you say for the moment, because there has to be a benefit in a performance-related structure. If the market, say, grows at 6% and Fund A gives you 8%, excellent, they've outperformed, they shouldn't be rewarded for that, they'll just get additional inflows. But if Fund B over 3 years consistently delivers 20% in a 6 to 8% market, surely the fund manager there is doing something illegal, remarkable, and could be rewarded for it in terms of that sort of incentive?
Well, I think that's when we've got to really get into the technical details behind is it correct, and it comes to what you said earlier about the benchmark. They could be getting 20% because they've just invested in a much riskier asset, and they might not.
But that's where it comes to behaviour.
Yes, and they might not even be. So that's why the benchmark's important. If you take a hugely risky benchmark, then maybe they're actually not outperforming in that scenario. They might have just bought a passively risky portfolio and it's outperformed. So, these are the technical things that we've got to get our heads around and be very careful with. We're in discussions with FSB as well, and we really want to take our time over this and make sure we understand it all correctly, because it is complicated, but we're certainly not saying that there's no space for it at all. It was just in the tax-free savings space we said not here.
Okay, and I think it's important as well in terms of building the credibility of the tax-free savings accounts. I mean, they've been quite a decent uptake. Are we where you thought we would be when these things started?
No, I think there's been a great uptake. I mean, there was some research by Intellidex, and they said about 2.6 billion has come in the first year and about 260,000 new accounts. And they think the service providers think about 20% of those accounts are new accounts. And we're very happy with that. We think that looks very good. SARS are busy looking at all the data at the moment as well, so we'll get much more detail from that.
Trying to figure out how much money you've cost them.
Yes, well, that's one of the things we need to do. So we calculate the tax expenditure of these incentives and how much revenue is lost, so that we can judge what to do and whether we should increase the rates and how much buy in the future years. So we'll be looking at that, but we're very happy with the uptake at the moment, and there's been a huge amount of advertising, which is what we wanted it. And I mean, a lot of the private sector companies are doing that in effect for us, which is pushing the savings agenda forward. And we think hopefully when the annual limit comes up again, in February, there'll be another push and say, get your savings in before the deadline.
The annual limit is sitting at 30,000 Rand per person in a household. So dad can put in 30 grand, mum can put in 30 grand, and into kids 1, 2 and 3, 30 grand each. It's got to go in their ID numbers and they'll have signing power on it. It's their money, not yours anymore, so you can't dodge future taxes in your own name by putting in your kids' names. That's important.
Yes, and it would be seen as a donation. So the 100,000 donations tax exemption would apply, but if you go above that, then donations tax would apply.
No, it's an exciting space, and I'm delighted that it's working. Also, the transferring from one portfolio to another, that was meant to be part of the flexibility of what the TFSA offered. You've postponed that once again. Why?
Yeah. So, it's a difficult one. We want to get this in as soon as we can because we think it'll be good for consumers to be able to switch from one to another. If they're with a provider that they're not quite happy with, we want them to be able to move and create a bit more competition amongst providers. But we were getting a bit of nervousness from the provider space to say, well, we're not going to be ready. We need quite a few months to get ready. And from our side, we needed to get final regulations out as soon as we can. So we've pushed for a 4-month delay, so it's not a huge delay, and then it can also align with the tax years so that we know that all the IRP5s and all the different certificates that companies need to give to SARS, it'll all just flow from one tax year and not be mixed sort of half at the last and half at the next.
It just makes administration very, very clumsy and very messy, and nobody knows which piece of paper relates to which year. It becomes incredibly complicated.
Yes,
What about fixed deposits? Because that's become a bone of contention as well, because you want flexibility within these TFSAs. The rules go, you can do 30,000 Rand a year up to a maximum in a lifetime of 500,000 at this point. My sense is that will be flexible into the future. Yeah,
so it's an interesting, in the draft regulations we put out, we're slightly changing our policy stance. So initially we thought, this is for short to medium term savings. People need to access their money when they need to. So we put in a limit of 32 days that even if you're in a 2-year fixed deposit, the product provider must provide the money to you within 32 days. The funny thing is that there are very, very few fixed term deposit products out there. So because this is an incentive, we're not forcing product providers to do anything. There's this funny tension between us trying to provide an incentive that is attractive and easy enough for providers to use, but also we wanted to have the characteristics that we're comfortable with. So the slight change that we're doing here is we're saying, well, perhaps that was too restrictive. So we're now allowing product providers to have the discretion on their fixed deposits. Well, this is the proposal, that they can have discretion on the fixed deposit. So if you go in for a 3-year fixed deposit, the provider can have discretion to give that money back to you or not, which is the same way as the current fixed deposit. So we're not changing anything compared to the current fixed deposit. And hopefully that will incentivize providers to start offering these products, which in the end should be at consumers' benefit, because then they can get a higher rate of return on the longer term fixed deposits. At the moment, it's just short term deposits and those interest rates are quite low on those products. So that's the slight change we've done, and we'll see what happens. We think it could also help for Basel III capital requirements. So that, because if there is discretion, then you can look at it as more medium to long-term capital.
But discretion with penalties or not? Because otherwise we go down a very dangerous and slippery slope there, because we know where the life insurance companies were 10 or 12 years ago.
Yeah, so that is something we're certainly not comfortable with. Which is one of the reasons why we didn't have these. We said you had to get access to these amounts within 32 days. But we also put in a penalty structure so that the penalty can't be above a certain level. So we put in a little equation for that in the regulations. To restrict the value of that penalty. So that stays. That's not going. So they still can't have these excessive penalties if you sign a contract for 20 years but you get out.
But people going into these things, so the fixed deposit in people's mind is, I can get my money in 32 days, or I get it, a 3-year fixed deposit, I can get it in 32 days. That'll stick. The moment there's a penalty, that adds a level of complexity to the upfront sales process, doesn't it?
Yes, so now, so at the moment it was 32 days and you can get your money. Now the draft is saying it's a 3-year fixed deposit and the provider's discretion. If you ask for it, they can say, well, we can wait till the end of the 3 years. But they can't. So hopefully it shouldn't be confusing for the consumer. Just the product provider can't charge above a certain level, like an early withdrawal penalty.
But you need to know that before, when you go into this product, that you are committing to a 3-year contract of savings.
And I think consumers know that, because for the current fixed deposit, that's how it is anyway. So, providers who provide these fixed deposits, they have discretion at the moment if you look in their fine print terms and conditions.
Is the idea still then to keep these TFSAs accessible so that people can withdraw? Because it's up to a maximum at this stage of 500,000 Rand, and say you've saved 100 and you draw 50, then you've only got another 450 to go in terms of what you can save during your lifetime, because you've used and accessed the 50,000. Does that remain in place?
Yeah, we do want the lifetime limit to remain. Another little change we've had in these regulations is that we think the product provider should also be responsible for looking at your lifetime limit. If you've stayed with one product provider and you keep putting the amount in, they must look and see how much you put in over those years. And it really is an insurance policy for us. We look at other countries and these products have worked fantastically well, but then as time has gone by, the revenue loss has been substantial.
For the fiscus?
For the fiscus in these other countries. So, it'll take a long time to kick in, and we've had some, disgruntled individuals saying, why even have this in the first place? But we just want to keep it there for now, just in case, and then we can, reassess as time goes by.
I mean, in a place like South Africa, where saving is a luxury of people with disposable income, is it encouraging savings at the lower end of South Africa's income strata, if you like?
Yeah, so we're going to have to do quite a lot of research to try and answer that. I mean, just from the initial anecdotal and survey evidence, it seems as if it might be in terms of the number of new accounts. When we look at the SARS data, it'll be the number of people who've suddenly started earning interest, who've never earned interest before. So we think it has started. It's certainly, if we make it simple and easy and tax-free is really the catchphrase here, then hopefully people will be incentivized to start saving, and it can help at the lower income levels.
The sort of questions I get from people trying to use this as some kind of tax loophole. It's not a loophole. The returns you earn over the period that you're invested are tax-free. That is the only bit. You can't take pre-tax money, invest it, and then get a tax break on the pre-tax money.
No, there's no upfront deductions. I mean, the incentive structure with the retirement changes and the retirement tax changes going through, the incentive structure on the tax side for retirement savings is actually a bit better. If you look at retirement annuities, I mean, you can contribute up to 27.5% of your income now.
Up to 350,000 Rand max.
Up to 350,000 max. And that is straight pre-tax money. And if you've contributed from after tax, you'll get a big refund from SARS at the end of the year.
There we go. No, look, I mean, it's really exciting what is happening within National Treasury and trying to create those incentives to save. Can you change the name from TFSA to something a little bit more that it's more investment related? Because I know they're savings products, but they're investment. They're real products in there as well.
Yes, there's quite a debate internally on that. But we've gone for tax-free savings account at the moment. In the legislation, they're tax-free investments, so you have both.
Okay, thank you very much. I'm happy now. Christopher Axelson, who's Director for Personal Income Taxes and Savings at the National Treasury. More ways and means to try and urge South African consumers, that includes you, to save more and invest more for the future. There is a future, believe it or not. Till next time, good night.